Between 1995 and 1999, the NASDAQ 100, the US technology stock market index, doubled in price every 2 years. Now, these kinds of returns might look absurd, but believe it or not, this is not that different from the returns that we've seen on the NASDAQ 100 more recently. Since its bottom in late 2022, the NASDAQ 100 has made a 100% return, doubling in price. In fact, when we copy and paste the price action from the late 1990s onto the last 2 years worth of price action, we see that they're actually quite a close match. The only difference, of course, being that the NASDAQ 100 sustained these gains for multiple additional years in the late 1990s. But we shouldn't be dismissing the idea of the NASDAQ 100 being able to sustain another melt-up like this today. While the 1990s bubble was fueled by optimism around the internet, today's technology stock market melt-up has been fueled by optimism around artificial intelligence, a theme that is just as real and just as revolutionary as the internet was back then. So is this what's waiting for us on US technology stocks? In which case we should really be going all in on this sector. Well, on a valuation basis, the NASDAQ 100 is about as expensive today as it was in October of 1998, which was definitely much closer to the end of the dot-com bubble than it was to the beginning. But from that point on, the NASDAQ 100 still climbed another 234% before making its final peak. And we can see that on this chart that shows us what's called the PE ratio of the NASDAQ 100. This is a way for us to gauge how expensive this index is at any given point in time, and the current PE ratio of around 30 has only really been seen during the mania of the dot-com bubble in the late 1990s and early 2000s. This right here was October of 1998. In fact, when we compare this to the PE ratio of the rest of the US stock market using the S&P 500's PE ratio, we see that there is a similar gap developing between the valuations of technology stocks and the rest of the market to what we were seeing in the late 1990s. Now, this gap right here is what a lot of experts point to justify having a negative outlook on tech stocks. Because not only are tech stocks expensive relative to history, they're also expensive relative to the rest of the market. But the truth is, when you look at the late 1990s, the gap got significantly bigger than it is today. This is what can happen when narratives like the internet or artificial intelligence take hold of the market. There's really no telling how big this gap can get. If you know a little bit about how market psychology works, it can be dangerous when the market begins to get too complacent like this. This can lead to a situation where the pricing of the market begins to diverge away from the fundamental reality of the situation. This is exactly what you call a bubble, and it's very typically fueled by widespread viral narratives. And right now, we're definitely seeing some of that with the technology sector in the United States. This chart, for example, shows us something called long-term earnings expectations of technology stocks. Now, that may sound a bit complicated, but it's basically showing us how high the earnings expectations of Wall Street analysts are on technology stocks looking out 5 years. So, for example, you can see here in the late 1990s, Wall Street analysts were forecasting that the technology sector was going to grow by 30% each year over the next 5 years. That would have been absolutely massive growth over a 5-year period. 30% growth is something that the market even rarely achieves within just 1 year, let alone 5. Then once the dot-com bubble blew up, these expectations came back down to more reasonable levels at around 13%. Now today, look at how much growth analysts are forecasting again. They're expecting the technology sector's earnings to grow by 25% per year over the next 5 years. Again, this is an absurdly high amount of growth, and in our opinion, it's very unlikely that this actually materializes. So yes, we are beginning to see signs that the tech sector is disconnecting from the underlying fundamental reality. But as George Soros famously said, when I see a bubble forming, I rush in to buy, adding fuel to the fire. So shouldn't this be our approach to today's AI tech narrative? If you can't fight it, join it? Well, to answer that, we need to look at this chart right here. This is a chart showing us the performance of the NASDAQ 100 index against the S&P 500 index over time. And as you can see from this chart, since the inception of the NASDAQ 100 index, we've seen it outperform the rest of the market by a staggering 400%. And just since 2002, tech has outperformed the S&P 500 by 230%. And it's done so in a very consistent manner. So yes, having exposure to tech stocks has been a fantastic way to outperform the stock market and could very much continue to be so over the next few months. Now, if we zoom in on the last couple of years worth of price action, we see the performance of tech stocks hasn't been all that impressive. While they did outperform the market significantly in early 2023, right after the release of ChatGPT that fueling this initial wave of optimism around AI, but since June of 2023, we've had tech's performance really stagnate against the rest of the market. To some, this can be interpreted as a topping process, with technology stocks ready to collapse under their own weight and finally revert back to reality. But to others, this is the tech sector setting up a base to move up higher and continue its euphoric performance. And we can rewind to 1999 to give a similar example. After a big run-up in late 1998, early 1999, the tech sector stagnated and consolidated for almost a full year before simply resuming its outperformance heading into 2000. And this is actually what we've communicated to our clients today. While we've been mostly neutral on the performance of technology stocks since 2023, this most recent move that we've seen on tech stocks could be suggesting that these technology companies are once again ready to outperform. Look at what happens when we add key moving averages on top of this chart. Over the last few months, they began to cluster together very tightly. And as that was happening, the technology sector began to form a base. If you know a little bit about technical analysis, you'll know this is quite a bullish development, especially if it's followed by a breakout, which is exactly what we saw last week. So we have flipped to bullish on technology stocks at Bravos Research, which is why we're currently actively scanning for long trades on the technology sector to add fuel to the fire. And we do already have a long trade on Amazon, for example, that's already up over 15%. Now, we're also closely watching this ratio, because if it comes back below the moving averages, that starts to look a little bit more worrying. The flexibility in our outlook is a cornerstone of our trading strategy at Bravos. We're going to be closing the year having done about 104 trades in 2024 at bravosresearch.com, 68 wins, 36 losses. If you want to be on top of markets in 2025, make sure to grab yourself a subscription to our service.